What's up everybody, Tom here with another video. Do I need to say any more when we have a red chart like this? Everything was down except for really the energy sectors, and overall it was led by big tech. We know, of course, when we get the FANG moving, things are getting serious. Have we just hit the buy the dip area, or is there a bigger correction to come? Stay tuned to find out more. Okay guys, well here begins our market recap for the markets closed 28th of September 2021. And you'll notice that when the markets opened, they just sold almost the entire time through the previous session. We had a little rally near the close, and then at the close, Wall Street dumped in. And this is important. Whenever Wall Street looks to actually dump into the close or they continue the selling, it usually means a little bit more seriousness is afoot. Nasdaq down 2.86%. IWM, the Russell 2000, 2.27, SP500, -2, and of course Dow Jones, the best due to energy sectors being slightly stronger. When we take a look at the actual energy sector, you'll notice it's the only positive for the day. Biotech really getting hurt there. Moderna also down hard. Novavax, all of these types of places. And then we had mostly across the board selling, but XLK, as we said, when big tech drops, everything just gets pummeled, and that's because they make up such a huge portion of the markets. Let's take a look at the PCC to get into our technical analysis before we go over to our SP500, Nasdaq, and of course options analysis levels. And you'll notice here the PCC, the put call ratio, it did spike back up. Now, when we get a higher put call ratio, if we actually scroll this out and we think about all the times we've ever, crashed or corrected recently or in recent times, you'll notice that most corrections, what will occur is the put call ratio will go up to a certain level, but it won't go that much higher unless it's very deep. So these are the very deep, very, very extreme zones. When you get extreme put call ratios, so that is that a huge amounts of puts are being entered into the market, it can get close to being the dip level. So that's being the kind of lowest point. You'll notice over here, it was around that 10th of March, 11th of March. We did go a little bit lower, but not that much lower after that point. And then over here, the 24th of December, basically the peak of selling in the 18 period. So why do we look at this? It's more of a contrarian indicator. When puts are really low, we might actually be looking at potentially looking for the shorts or looking to hedge our portfolios because no one else is doing it. When puts become a massive part of the market, it's like Warren Buffett says, when others are being fearful, you might want to be greedy. And we want to bring that together with our technical analysis level. So 1.15, a decently high level. We're on support here ahead of the next market open. Do we expect dip buying? We'll try to answer that in just a few moments. Let's move over to the SPY now and talk about the close. So the close happened at the exact same level as it did the previous time. You'll notice here the sell-off close, full rebound off the 430, where we know there were quite a lot of puts placed. And then we got back up, moved into the 20 and the 50, our danger zone, and then we've sold straight back off into the level. 433 is the zone it's at the moment. 430, of course, being the heavier support in S&P 500. But I think to answer whether this is going to go completely or further down, we need to firstly look at some of the scenarios of what the market's doing in terms of the 1 hour, 2 hour. So let's look at the close here on the SPX. And what you'll notice is it's a slight rally, bullish kind of pin bar, bullish pin bar, bullish pin bar, bearish pin bar. So what's that? Basically on a 2 hour, it's a long leg doji. And then we have some selling into the close. If we now move underneath this zone, what that does is it allows basically all the algorithms and of course sellers to come back in and push it towards the 4,300, the 430 on the SPY. If we close underneath this level, it seems inevitable that we'll test this zone. And if we close under this level, wow, it's really on then, because that's when the bears are fully in control and they've done something that has not happened in quite some time. Basically, we will have what we call the lightning bolt. The peak over here, the trough, the lower peak, and the lower trough. If this happens and we close underneath, I'm pretty serious about a 8 to 10% correction. And to put this in perspective, if we think about where it currently is right now, it's down about 4.21%, and 5.27% from top to bottom was the best that happened. A 10% correction or 8 to 10% correction puts us in the vicinity of potentially down to the 4,050 level on the SPX. And that would be a pretty damn serious deal. Now, I know a lot of bulls and bears have been kind of fighting about this idea, but when we put things in reality, is it really that big a pullback? No, we've got a very healthy market here. Am I concerned about the US debt ceiling? I think they'll get it done. I mean, you guys can let me know in the comment down below what you think is going to happen with that. Am I concerned about the China debt crisis problems? Yeah, I've always been concerned about that. But again, I think they'll probably overcome that one. And then the next question becomes, are you concerned about like energy? Not really. And of course, the last one will be the yields. And I've mentioned several times, the yields may spike. I think they'll spike to 2%. I don't know when, but I'm pretty sure they will eventually spike up to this 2% area. That will cause this kind of correction or kind of fear in the markets, but I don't think there's a strong correlation between that and hurting the Nasdaq and the SP 500 over the longer term. In fact, it will help the banks as well. We've got to remember some sectors will benefit from this. So here's the previous support buying that happened back in May of this year. And if we get back down to that level, we're going to hit a 50 exponential moving average on the weekly. Now, if we put this out to perspective, look how good the 50 has been on the S&P 500 at being a great big correction dip purchasing. Has it sometimes gone under during more serious corrections? Of course. But the 50 is an incredible moving average to be predicting those dips. Now, 20 is also incredible. 20 is for the shallower ones. And that's why so many people have just been picking up the 20 the whole way across here. And we're just around the 20 right now. So I'm sure some people are buying right at this point. Let me know if you are in the comments. But yeah, the 50 is the next stop. So we have all these key support resistances. We know that if we close underneath this zone down here, which is the 4,300, then we look to move towards the next most logical zone. The next most logical zone is around that 4,200, 4,240, previous support, previous resistance. And if we close underneath there, you'd be looking at a flash sell down to the 50. There's not much holding it up between this zone. And we always look for left-hand side support or resistance before making better decisions. So this is a really interesting time here. If you're a bear in the market, you're probably getting pretty excited because the salmon are out. And of course, you're trying to eat them up. That's what the bears are doing. Let's take a look at the open interest. This gives us a bit of an idea where the market is looking to close for the week ahead. And this is for, of course, October 1st, so the Friday of this week. We talked about the call wall. So basically a call wall, for anyone that doesn't know and you're new to the channel, is an area where the market is unlikely to breach due to the fact that it would have to pay a lot of money to all of these call buyers. So we had a call wall sitting here at about 450 this week. We also have, of course, the 440 call wall sitting there as well. Now, it looks like both of those don't really want to be reached. Now, we don't have so much a 430 put wall, but we certainly do have like a 425, 420 put wall. So if you were thinking about how could I make the most amount of money in the market, somewhere in around this zone here is the maximum pain. So this is basically the optimum area for Wall Street to finish the position. So we're right around that. We're right around, being able to go a little bit lower and still make maximum amount of money from all of the options expiring both sides. So just remember, that's how we read these charts. It's a bit contrarian and there are a lot of good reasons for it. Now, if we go into, of course, October, we've been talking about this chart as well. The 450 was just struck incredibly heavily during that FOMO that everyone was feeling in August, where the market would never go down 2% or 3% ever again. We all remember that. It only happened a month ago, if you can believe it. And we were definitely neutral on this channel. We didn't have a bullish intention other than the longer term because we still are very optimistic on the market returns. But we know that August and September tend to be these volatile months. So because we've got this big 450 call wall there, it's unlikely that the market will be above 450 before the 15th of October. So we don't have that much puts in here in comparison. You can just see how massive this call wall is. It enables these bigger corrections to occur when we see these types of things. Remember, the market will want to expire this. So I guess bulls have a bit of a zone where they're like, okay, it's unlikely to be above there, just statistically unlikely to be above there. We're bearish at this stage. Can we move below the 4,300 and then really open up that 42 and then possibly even 4,000? Do I think it gets below 4,000? I tend to think that's going to be very surprising, but maybe it will, but I don't think so. I think that's probably about as low as it gets. In general, good corrections, healthy corrections in the market 8 to 10% is what most big fund managers expect. Just remember that. Another big warning sign that we've got that the market could be coming down is, of course, the DXY. We've been waiting for this for ages. And this is a massive double bottom that's just closed on the daily to a new high. Let's put it in a weekly kind of chart here to show you how massive this is. So this is basically saying that the dollar index is going to go bullish, and it is going to go bullish for a sustained period of time. And realistically, everything looks great. We've got the 20 moving average. We've got the 2050 about to cross up, which is consistent when you get these double bottom breakouts. You've got a slope that's been improving here and a long leg doji that looks like it's going to close above for the weekly. So all of this is pointing towards more strength in the US dollar. That could mean that people are hedging. When people are hedging against uncertainty in the markets, this is the type of thing they look for. Let's now move over to our stocks, and we'll start off with Tesla. And you might think, oh, Tesla's down, Tom, it's bad, 1.74%. Look, 1.74%, considering the market, the SP 500 was down over 2.5%, is an incredibly strong looking chart. It's still very strong looking. It broke to 800. We know that's where there was a lot of calls expiring this Friday. So it was kind of unlikely it's going to get past that level. And we're moving back down. Where's the next kind of support resistance? Well, we have here the 762, 760. Previous resistance should act as support. And if you are looking at Tesla, I mean, this might be as low as it goes. We also have the longer term trend line that backs up some longer term kind of investment levels for some people around this zone, because this is still a very strong chart. And we always go back and we need to look at the top down analysis and get the fact that this is not a bad thing. What's happened here is we've closed above a rejection wick. There's the rejection wick. We've put a weekly above it. We haven't done that since all the way back in 2020, pretty much into the start of 2021. And this type of chart is pointing towards that 880 once we get through 800. I mean, there's just a very high statistical chance that's what it looks to do from a technical standpoint. Obviously, you've got to make your own decisions. But look, it's happened plenty of times before. We've got big breakouts, and when you break past that critical level, Tesla tends to go on a mega run. So remember, 800 is a very important zone here. Keep watching it, and the chart overall is still looking quite bullish. When we take a look at the actual option strike interest, we still have a huge amount of puts that are open all over the 700. I always expect these to expire worthless. I don't know who's putting these in, but it doesn't seem that smart. They've actually been puts that have now started creeping up. So we've got puts now all the way up to around that 740 zone with fairly heavy selling. And the call buyers in comparison, even though this market's actually been going relatively up on Tesla, is much lower. And this is quite common with most stocks. When everyone goes bearish on a stock, you'll find that often it will go bullish and the price action will actually be bullish as well. Apple, let's take a look at this. This is the most important chart in the FANG stocks to be watching. We are on support again, 142. We know this zone. We've had this box drawn up now for a few weeks. We absolutely know this is super critical because we have a peak, we have a trough, we have a lower peak. And guess what, guys? We would have a lower trough if we go underneath this 142 zone. And once we get underneath that, if we do, then we're talking 135 as the next key support, the 200 daily moving average, and we've got the beautiful trend line. And a lot of people have invested off this trend line over the past. So if you're an Apple fan girl or fan boy, this is the kind of zone that many investors will be looking at. Many people on Wall Street, they'll love this trend line. They'll be looking to invest their clients here. And look, can it go lower? Of course. We don't know that it's going to stop here, but this is a highly accurate trend line so far. So this is something to watch. And if you're an Apple person, that's what you're looking for. If you want to buy the dip on the next session, then you're really looking at probably around this zone, targeting in, going the smaller time frames, looking for turnaround stories, and then trying to take that back up to that 145. But closures underneath our red box here, I'm thinking it opens that 135 can of worms for Apple. And I feel like it's a great level from a technical standpoint. Let's go over to the US 10-year. This is what's got people concerned. I'm not concerned over the long term here. I'm still a bull in the markets guy. Guys, I'm really looking at taking this market for the next couple of years, especially into, I've got about 2026 and a half kind of is my zone that I'm looking at. The 10-year doesn't worry me. Even if it goes to 2%, it still doesn't worry me. If it starts going hyperbolic past 2%, of course, then we have to start questioning what exactly is going on. But there's still plenty left in it. And I'll show you why 2% is such a key zone. So it's that previous resistance that was caused in 19. And this will put downward pressure on the Nasdaq, at least temporarily. But remember, if it goes up there spikes, that's going to scare the Nasdaq. If we expect it to find resistance here and it starts consolidating or even moves down a little bit, what will actually happen during this consolidation is the Nasdaq will just go up because it becomes the norm. People go and actually look at it and they go, oh, maybe it's not as bad as we think. It's that initial fear, that initial speed of the market and all the algorithms doing their things that scares people out. And remember, at that point, we're not there. We're currently at resistance on the US 10-year. We're at support on many of the SP 500 and Nasdaq. So this could cause a little bit of an initial bounce. But if we close below these zones, just remember, and this thing spikes through, it seems inevitable it's going to go for 1.8 or 1.75, 1.76. And then if it gets through there, of course, 2. And this will bring, I believe, that further pullback in the markets. Have a look at IWM. IWM's in the middle of nowhere land. We've got 220 as a big support, daily 200. We closed above 225 due to the 10-year going up, and then hyper stocks got bashed yesterday, so they all came back down. Look, the financial sector of Russell is probably going to do okay, but as long as the 10-year keeps going. But realistically, this is a very tough chart to read, and the reason why, we're in a massive channel. If you see charts like this is really your options credit style, selling credit type of opportunity. That's the way I look at these types of channels, but some people would like to trade it, so we're still covering it here on the channel. Let's move over to QQQ, what you're probably all very interested in. And I tell you what, it looks pretty marginal. Now it's up in the futures. We're trading at 14,820, which is pretty close to where this actually closed, because about 360 is equivalent to that. But we have a peak, so a peak to a trough, to a lower peak, to a lower trough. And for some people, this will be considered a closure breakdown. Look at the volume as well. The volume was huge into the shorting trade. In fact, the highest volume we've seen, let's have a look here. The highest volume we've seen since March selling. So very close to kind of those initial dips. And what you'll notice about any correction or crash or whatever you want to call it, is the market will often quickly zip back and show buy the dips and then have further sell-offs. Now that peak, trough, lower peak thing, so this thing here, the lightning bolt down, is really the important factor. If you are shorting here, your next zone is going to be around that 352. There's basically what we call free zone in here. This is the participation zone. Very little left-hand side information backing it up. Just like yesterday when we said once it gets past 15,000 on the Nasdaq, and it goes down, what's going to happen at that point? Well, we're most likely going to go towards the 14.8. Once we get underneath the 14.8, the most likely statistical factor becomes the 14.5. And if we get underneath the 14.5, the most likely is to go for the daily 200, go for the previous resistances, becoming support, the 340 on the QQQ. These are the three key zones. If you're looking to buy the dip, you're looking for a turnaround story on the smaller timeframes here, lightning bolt, base formation, double bottoms, all those types of things. Super interesting chart. The indices are where it's at. And if you're even looking at stocks in the indices, if you see these turn around and you see bases forming on your favorite stocks, remember the index has to really go up for all your stocks to go up. Because if it isn't turning around, only very specific ones with certain earnings will move. Super interesting chart. We'll be watching it. Let's take a look at the US 100 just quickly so you can see where the support is. Again, a pretty bearish looking close right onto our support. We go down to the 2 hour, and when you look at this, most of this chart looks really bearish. Maybe a 14.9 closure above is kind of a little mini signal that some buyers are coming back in. But other than that, if it stays within this zone, and especially if it closes below these lows here at around 14,760, let's call it, that area should create further selling, and then we're talking 14.5 or 14,000. Don't forget, guys, and Nasdaq has a monster channel on it, and this is the kind of Christmas come early for a lot of dip buyers. I think Wall Street has this one firmly in their sights. Support, 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 support. That is the previous resistance. That is really the most likely scenarios to hit the bottom of this trend line, whether it's 14,000 exactly or 14.5. Once it hits this bottom, I think there will be dip buys. So remember, keep this trend line in. If you're interested in getting a copy of it, I'll put it in the Discord, in the public room. I'll just take a quick snap of it so you guys can have that on your charts. It's a fantastic support line, and I'm even more excited because if we hit this and bounce, we have a great take profit target in the future. So I'm really, really excited about that. Let's move over to Bitcoin here. Bitcoin getting kind of pummeled by the rest of the stock market. We're still on the support of 40,800. This area is slightly holding up. I've got to say it's pretty weak considering we had two big bounces. We just didn't have that follow through. We're stuck between this level and the 45,000 on Bitcoin. Nothing much we could say about that other than it's stuck. And then if we move over to Ethereum, it's a very similar scenario. Ethereum slightly stronger than the Bitcoins. We're looking for a 3,200 break to show the bulls are back in control. And otherwise, if you're trading in this range, you're just trying to be nimble and fast. It's basically a giant channel on the smaller time frames. Be nimble and fast, guys, when you're in here if you're looking to the trade. 2050 cross to the downside. A fairly negative first signal, but I'm going more with the price action than the moving averages here. There are some other coins that are doing a little bit better, but even Cardano, I mean, this looks very weak. There's the downward trend line. We've got that $2 being the heavy support. It closes underneath there. Could create a bit of a flash crash. We're going, I believe, $2 underneath goes to something around $1.80. So everybody, I think it's okay in these markets to be bullish. We need to realize that the stats with these types of things are always generally rigged towards optimism. And remember, it doesn't pay to be a bear for a very long time in the markets. Bullishness wins the day in most scenarios. We just had 7 months of winning streak on the SP 500. Generally, we do get that kind of weakness after that. You can see the statistics over time have been very few have been so bullish. And then we go to the 3 month and the 6 month. The 6 months is usually 93% of the time it is bullish. I will also share this, which I got in the private or public Discord community. And basically it's a cool chart here. And what it's showing us is it's showing us the amount of companies. This is provided by the felderreport.com. And basically it shows us the number of companies valued at over 10 times revenues. And when you look at this chart, you go, wow, that's pretty crazy. I'm not sure whether we should be concerned about it. I mean, it's obviously a worrying factor, but there are certain similarities to the dot-com boom, and then there's certain similarities that aren't there. There's a lot of companies that aren't really earning money. Remember, this means that a huge percentage are not really earning a huge amount of money. They're being valued at very high rates, but there's also some real companies here with real growth potential. Over here, it was more of a fledgling idea. It was kind of like Bitcoin back in the initial big bull runs. This is more where some coins other than Bitcoin were basically scams or something else. I see this as being a little bit better, but still something to be worried about when you're looking at these valuations and how many companies are heavily valued at over 10 times revenue. Good luck out there, everyone. Remember to subscribe, smash that like button if you enjoy our content, and we'll see you live 1 hour before the market open, of course, for Wednesday. Bye for now.